Hello and welcome back to Instant Insights. At Global Data Strategic Intelligence, we track over 100 tech, industry, ESG, and macro themes impacting all major sectors. I'm Carolina Pinto, and today I'd like to welcome back Rory Green, Head of China and Asia Research at TS Lombard. Rory, Happy New Year. How are you?
Happy New Year. I'm great, thank you. How are you?
I'm good. Thank you so much for coming back on the podcast. And with the new year, of course, we have to kind of catch up with you and get your opinion on what's going on in China and China's outlook for 2025. So to catch up the audience a little bit, in 2024, the Chinese government began rolling out some fiscal support to address some of the country's domestic issues, namely the high debt level and low consumer demand. Rory, how do you think the government will proceed in 2025? Can we expect more of the same, or will they take a different approach?
Yeah, I think this is really the key question for China macro. The fiscal outlook, and of course the tariff outlook coming out of Washington. But for China, we think a different approach is coming this year. And as you said, they did do a little bit of fiscal last year. But it was not that much, and they've been pretty passive since 2021, really. And the reason for that is Xi Jinping basically looked at the economy. He saw headline GDP growth was doing okay, and tech, advanced manufacturing was doing fantastic. And for him, that was fine. He was happy to be on a slightly slower growth path, trying to cut down a bit of debt and doing really well on the tech side. Mm-hmm. What we think has changed is that the social pressure on the government to do more, to drive growth, to create employment, to raise confidence and expectations has really kicked in a big way from the middle of last year. We look at trackers of social unrest, protests, economic discontent. And these are all tracking at near all-time highs, well above what they were during the pandemic and the lockdowns. So that combination of social and economic weakness, we think is going to push a change in government policy. And we should finally see a more significant fiscal push this year. There was a bit last year, but in general, since 2021, the government has been doing exactly the opposite of what an economist would have been advising, which was cutting back on government spending while the economy is weak. This time round in 2025, we think finally we're going to get more fiscal and probably enough to stabilize domestic investment and domestic demand. So quite an encouraging outlook on the fiscal front.
Okay, so you, alongside the fiscal policy, you just mentioned tariffs. So another big concern for China is, of course, at the time this goes out, within about a week, President-elect Trump will come to power, and a big concern for China is his tariffs policy. Trump has threatened to impose up to 60% tariffs on Chinese goods. What is the potential impact of these tariffs on the Chinese economy, and how will China respond?
Yeah, this is, again, one of the key questions, not just for China, but globally. From a Chinese perspective, the impact this time around, we think, could be greater than it was in the first trade war. And China is actually now, we think, more vulnerable from a macroeconomic standpoint to trade tariffs than it was back in 2019. So although it's lost market share within the US import market, its share of global trade is higher. In fact, it's an all-time high. And that would suggest that China has diversified a little bit from the US. But in fact, we think a lot of that rise in global market share is in fact transshipment and rerouting to the US as the final source of demand. And that big uptick in global exports means that manufacturing and investment tied to exports is now a larger percentage of the economy than it was back in 2019. Manufacturing actually gone up in China over the last 5-6 years, whereas traditionally you would expect as China develops, that should shrink and services would take on a greater role. Mm-hmm. But because of the weakness in the domestic economy, it's exports that have been driving growth. 40% of growth in the second half of last year came from net exports. And that makes China very vulnerable to the prospect of large-scale tariffs and efforts to limit the rerouting of Chinese goods. So this is a real danger for the economy, and in a worst case scenario could knock almost a percentage point off potential growth. So it's a pretty big hit. Beijing will of course respond to tariffs. Four main measures. Number one, a weaker currency can offset some of the cost hit for importers. Number two, retaliation, both with tariffs on US goods and also restrictions of certain Chinese exports, including rare earths. Number three, fiscal, which we've touched on, and this is the most important one, to try and get a bit of domestic growth to counteract the hit on the export side. And then finally, something a bit longer term would be accelerated trade rerouting and outbound investment. And this is something that Xi Jinping himself is pushing directly, getting Chinese companies to go out, set up manufacturing facilities in, say, Eastern Europe, South America, Mexico, Southeast Asia, as ways of getting around globally proliferation of tariffs. That's a longer term drive that is going to accelerate, we think, this year as well.
So in Europe, for example, there is quite a lot of investment in the batteries and in automotive for Chinese companies to invest in European countries to get production going. But will those types of investments not be targeted as well by tariffs or at least restrictions?
Yeah, for now, I think Europe is moving quite slowly on this. And we've touched on this, I think, in previous podcasts, that there's a split in Europe, and you can see that split when you're walking around on the streets in Beijing. You can still see a lot of BMWs and Audis, but there's no Peugeots or Fiats. So you've got the Italians and the French that are pushing for stronger tariffs to try and localize some Chinese production in Europe, or at least keep out highly competitive Chinese EVs. And the Germans, still somewhat surprisingly, are reluctant to go hard on Chinese exports. And I think that kind of mixed approach is going to continue. China's willing to invest in Europe to gain access to the market, and they'll push that this year. And I think Europe will generally welcome it with that sort of mixed approach, and the balance between France and Germany, both of which have their own political difficulties, the key determinant there.
That makes sense. As you mentioned, the trade war going into 2025 isn't the beginning of the trade war. It's really an expansion on what started in 2019 and specifically what started with both US and China targeting each other's tech sectors. Do we expect the tech sector to be targeted again in 2025? And if so, what areas? And something I've been kind of wondering as well is, in your opinion, is the tech sector better equipped than other sectors to deal with this price volatility and supply chain disruption caused by the trade war, just because they've already experienced an attempt of bifurcation of supply chains?
I think yes to both. Yes, more pressure on tech, and yes, it is better positioned now, the industry as a whole, to withstand greater trade restrictions. Particularly the Chinese industry. There's been a very strong de-Americanization push that has gone pretty successfully. Of course, there are choke points, and the US is key in a number of areas, from semiconductors to other aspects of advanced manufacturing. But in general, China has significantly reduced its reliance on foreign inputs, particularly in tech, and I think will have been building up a pretty substantial inventory of NVIDIA chips, ASML, EUV machines as a hedge against greater tech tension. Where I think there may be potential for more disruption is possibly in the US with changes to the Inflation Reduction Act. That's been very beneficial for export competitors of China, say mainly Korea, Taiwan, and Japan. So that typically all four of those Northeast Asian countries would be competing for the US market, but Biden effectively blocked Chinese products and then subsidized consumption of all these goods that Japan, Korea, and Taiwan produced. And if Trump does go after the IRA, we may see those investment plans in the US be disrupted with the knock-on effects for supply chains.
Now that you mentioned on the US side, Japan, South Korea, etc., and then on the China side, you also earlier mentioned the redirect of manufacturing to circumvent tariffs. What are the trickle down effects of the trade war on the rest of the world?
Yeah, it's great question. I think broadly it is going to mean China continues to be deflationary for the world apart from the US. So if Chinese goods can't flow to the US, they're going to go elsewhere, and they're already price competitive, but with a weaker RMB, they'll be even more competitive. And you may even see cases of dumping of Chinese products into other markets. And we saw something like that in the first trade war, with Chinese goods being redirected into Europe as the next largest market. So downward pressure generally on prices for manufactured goods. However, we do have one idea of a different spillover that is probably not yet priced into markets, and something that investors should consider, and that's potentially higher commodity prices. So what this setup that we're talking about here would be strong fiscal stimulus in China, but also strong tariffs, and that could shift the composition of China's growth. So since 2021, relying on foreign demand, now tariffs, no foreign demand, or much less of it, and having to shift back to a more typical China growth story, where it's consuming these commodities for infrastructure investment, maybe even a bit of a property upswing cyclically, and consuming these manufactured goods at home. And that would be a positive demand driver for commodities, and the first time we've seen that from China for a long time. So that is one to watch for, not on the consensus outlook. A return of China's commodity demand and potential upside for global industrial prices.
Would that happen in 2025, or is that a bit of a longer outlook?
No, I think that could happen quite quickly in 2025. In March, we'll have the National People's Congress in China, and that's where we'll get a growth target, how much money they're willing to spend on investment on the consumer. And that will give us a good idea of whether they could credibly be a net contributor to global industrial commodity demand. And actually longer term, it's still very much a structural slowdown story in China, with property continuing to weaken on a longer term basis, and that being negative for, say, traditional commodities like iron ore and cement. But we may get a brief upswing in 2025, and one that could be a good trading opportunity.
Oh, that's really interesting. I hadn't thought about that before, but we've run out of time. So thank you, Rory, so much for coming back on the podcast. And for everyone at home, thanks for listening. And from us at Strategic Intelligence, see you next time.